Welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Ms. Aditi Nair, Chief Economist at ICRA, joining in. Welcome to the show, Aditi, and always a pleasure to speak to you. Aditi, my first question coming to you is, we just had the inflation numbers that did come in. Wholesale inflation has eased to around 10.7% in the month of September, though there has been a base effect that has creeped in. What's your read?
Thanks, Hiral. The downtick in the WPI numbers for September was entirely on expected lines. Our estimate was 10.6%, so this was pretty much in line. The CPI numbers had, of course, given a little bit of a negative surprise, going up to 7.4%, which was higher than our forecast of 7.2%. Within the CPI numbers, the main issue was on the food side, and that's really, one of the watch outs that we have now going ahead. We've had lots of specific issues with the heat wave and then the edible oil crisis globally, which is easing off. But now we've had the very heavy rainfall at the beginning of this month, and we need to see what is the lasting impact of that on the perishable prices and also on the Kharif harvest of rice. As it is, the rice sowing was below last year, and the advanced estimates are looking at a production being lower than last year, which was before we had this episode of extremely high rainfall. So we need to see how these trends play out on the food inflation side over the next couple of weeks to get a better sense of whether there is really going to be a meaningful shock on the food prices that will sort of become a bit sticky within the numbers going ahead, or is it something that is going to be a more absorbable shock on the food inflation side? For the WPI, two things matter a lot. One is how global commodity prices move, and the second is how the rupee moves. So the rupee is less important for the CPI, more important for the WPI. Similarly, for the global commodity prices. On the other hand, food prices are much more important for the CPI than for the WPI. So what we think is going to happen with the WPI is that we're going to get a further easing off as the base effect becomes more pronounced. And if the global commodity prices continue to sort of moderate going ahead, then we're probably going to end up with about a low single-digit WPI inflation in the last quarter of this fiscal year. But the average for the year, of course, is still going to be around 10%.
Right. So with this inflation number, if you talk about the IIP, the industrial output as well for the month of August, that's actually fallen for the first time in 18 months. What does that actually signal to us now?
See, my assessment is that we need to look through the IIP data. The other high frequency indicators for the month of August and September are pointing to a much stronger non-agricultural economy. Particularly if you look at the GST e-way bill data, which gives us a great proxy of how the manufacturing sector is moving through the month. Here we've got a lot more robustness, which is coming through the August and the September numbers. And whatever I can see and hear anecdotally about the festive season is also pointing to at least a temporary sharp demand. Maybe it's pent-up demand for the festive season because we've had festivals mired under the lockdowns in the last 2 years. So it may well be temporary. But at least what I can see around is that the festive season spending seems to be really quite strong. And it's very different from what the signal that came through the IIP data. So my sense is that perhaps the GST e-way bill data is giving us a better proxy for what's happening currently in the economy than the IIP, which does have a very old base. And therefore, there may be a lot of exclusion issues that are coming through in the data over there. The other factor is the export side. So we got the initial data for the month of September, which was not positive. We had a contraction in exports, merchandise exports as per the initial data. But the revised data that came in on Friday is showing that both oil and non-oil exports were revised upward. So that's at least positive. It's better than the data that we got initially. Having said that, of course, we need to be very careful about what's happening with exports going ahead. We've got, I would say, a triple whammy on exports. We've got commodity prices going down, which means that the prices would be lower. Secondly, we've got flagging external demand from the advanced economies. And thirdly, the rupee has appreciated against the currencies of some of our competitors. And with all of this, it's really not a great combination in terms of supporting the export outlook for merchandise. On the services side, we've still got pretty strong numbers coming in up to the month of August. Again, we need to be careful about what kind of budget cuts there might be for our software exports, etc., and how all of this is going to add up going ahead.
Right. So now taking these two numbers into consideration, it's going to be imperative as to how the GDP growth will look like, as well as what will happen with regards to the RBI in the next cycle in December 2022. What's your read in terms of growth? Because currently, indicators are showing us positivity. However, when you look from the fourth quarter onwards, how are you seeing it?
So we believe, that growth is going to be higher than the MPC's forecast, particularly for Q3 and Q2 and Q3. So even after the MPC revised the full year forecast down in the September policy, they actually ended up revising Q2, Q3, and Q4 upward. And our current forecasts are even higher than what the MPC has put in the September policy for Q2, Q3, and Q4. Now, on Q2 and Q3, I think, Q2, one positive thing which is coming through the early results is that profit growth seems good. That's the general sense I have. And lower commodity prices in that quarter would have definitely helped the business margins. Also, the GST data for August and September suggests that companies would have had started sort of stocking up for a good festive season, and that should help the volumes in Q2. Q3, the spending buzz that we're talking about, also contact intensive services seem to be doing very well right now, whether it's hotels, banquet, leisure travel, airline traffic, etc. All of these indicators are pointing to a robust demand for services. And between that and the festive season, I think Q3 also is looking quite good from a growth standpoint. Q4, perhaps we're going to find that after a bit of a binge in Q3, people might cut back on spending to a little bit to some extent. Also, we'll have a better sense of how much the global issues are going to affect our exports on the merchandise and the services side in Q4. So I'm a little more cautious on the outlook for Q4 and beyond. But Q2 and Q3, I feel the GDP growth data is going to be higher than what the MPC had projected.
Right. So with all of this said and done, with the way US is going, with what's happening across Europe as well, how are you seeing that impact the Indian market? Do you think we are resilient enough, or is there a cushion, or if we will see a major domino effect coming in?
I don't think it's going to be a major domino effect. We're not going to be immune to what's happening in the rest of the world, that's for sure. But at present, to me, it seems like consumer sentiment is very strong, and the desire to spend is also very strong. If this can sustain beyond the festive season, then I think we're going to be able to absorb the hit from lower exports. But that's also going to take a cue from whether any of our export-oriented sectors have to have significant job losses, etc. So it's very much a work in it's unfolding right now. What kind of an impact we're going to end up having from the global issues to the Indian economy, and whether what seems to currently be very strong domestic demand, whether that can sustain going ahead. So my sense is that the demand for services will last even after the festive season is over. But the demand for goods may go back to a more normal level. Basically the trends may go back to what we saw in Q2 rather than what we anecdotally think is happening right now in Q3.
Right. And overall, if you see in terms of the RBI as well, they've completely remained focused on withdrawal of accommodation. They have suggested additional rate hikes will be in store. So with this scenario, December, as well as if you have to look at FY23, how much more rate hikes that could be in the box right now? And secondly, how do you see the RBI adjust to what's happening around?
A couple of things. One, after the higher than expected September print, we think that there will be another rate hike in December. The likelihood of that has gone up significantly after seeing the September print. We're tracking an October print, which is closer to 6.5%, right? So more this, significantly lower than September, but still higher than 6%. That's another reason why we believe that we will get another rate hike in December. The quantum of that will be determined by how far above 6% we are, how strong the Q2 print is for the GDP, and also what is the 6-month, 9-month, 12-month ahead CPI inflation number looking like as far as the MPC's own projections are concerned. We got minutes which were very divergent for the September policy, and a couple of the MPC members seem to be saying that we're close to the end of the hiking cycle. So, on balance, we may still end up getting a vote which is for another hike, but I don't think it will be a unanimous vote for another hike. Now, in terms of the terminal rate, if I look ahead to inflation growth dynamics, 9 to 12 months down the road, I don't think we need to tighten significantly more from where we are right now. Because the more we keep tightening, the more we are going to be in danger of creating a growth sacrifice for trying to control an inflation that is really not in very much in the control of domestic monetary policy. So my view, my assessment is that the growth sacrifice should be minimized, especially because we do think that inflation is going to average around 5% in FY24, maybe 4.7 to 5%, depending on the monsoon, depending on global prices, etc., the commodity prices. But even if we take 5% and we get one more rate hike in December, the real rate is going to be upwards of 100 basis points, and that's probably more than adequate in the current scenario.
Right. And with the RBI as well, they've clearly indicated that they are expecting a pickup in liquidity with the government spending gaining traction. Now, with that, if you see, the suspension of the 28-day variable reverse repo rate has happened. Do you think OMOs as well as an eventual cut in CRR are a possibility?
See, I think the main tool is going to be the VRR auctions. I'm not ruling out a cut in the CRR back to 4%. So I think that there's not a very high likelihood of that, but we're not ruling that out because if the frictional liquidity is one thing, but if the durable liquidity starts coming down, then we could certainly expect the CRR hike to be reversed. But that's unlikely to happen in a hurry because as of now, the durable liquidity numbers are fairly comfortable. So if we start seeing durable liquidity crunching down as we go deeper into the busy season, then the possibility of CRR cut will become more likely.
Right. And with this said and done, how are we seeing the bond markets factoring the RBI tightening, and what range do you see the yields moving in?
See, bond markets will factor in any additional tightening. I think there are parts of the market that are looking at the OIS and looking at a higher terminal rate than what I mentioned, for example. So there is still some amount of divergence within the market in terms of whether there will be one final rate hike in December or December plus February, and where we need to end up. Whether we need to sort of keep matching the Federal Reserve or sort of look at our domestic drivers and stop at some point. We probably have to stop hiking much earlier than the Federal Reserve. Especially because our inflation is not as far away from our tolerance level as what is the growth in the US. Now, on the 10-year, we've seen some amount of hardening, which has already crept through in the 10-year yield. Even though the spread with the US 10-year has compressed a lot, I think that is less relevant at this point in time, especially from an FII debt point of view, because the flows are quite low. So I don't think that the spread needs to go back to what it was necessarily. But couple of things. One, crude oil prices are still fairly volatile. We saw them going up after OPEC announced the production cut, but global demand concerns keep resurfacing. And therefore, it seems more likely that we're going to have sort of a cap on commodity prices. The commodity prices will go up to a certain level, and every time there are some demand hiccups which come through, commodity prices are probably going to correct a little bit after that. And that's basically good news for inflation readings in general. So that's one factor. Government of India, so far, we think the fiscal balances are reasonably comfortable. And we are still looking at a fiscal deficit to GDP ratio of 6.4%, which is what was budgeted. In absolute terms, there may be a small overshoot. We can't rule that out, but the tax numbers are still very good. And we don't think that there are too many concerns on the fiscal side. So in the immediate term, I would say in this quarter, we could look at the 10-year yield maybe max if with lots of bad news or with crude oil prices going back above in the range of $95 to $100 per barrel, maybe 25 basis points higher than where we are right now. I don't think, especially now that the uncertainty about the bond index inclusion is behind us, so that's already baked in that that's not happening immediately. I wouldn't say that there would be an upside of more than about 25 basis points from where we are right now.
Right. And very lastly, Aditi, if you see in terms of the forex reserves, the depletion has been quite rapid of late, right? And yes, it has been driven by multiple factors, including depreciation of other currencies against the dollar, a rise in global, bond yields, and a fall in gold prices. How are you looking at that scenario? Do you think, I mean, how would that mark-to-market losses account for in the fall to forex reserves over the past 12 months, number one? And two, how do we see the rupee moving from here on? Because clearly, yes, there is aggressive movement by the Fed. I mean, FPI outflows probably now should be behind us as well.
Right. So my view is that on the, like I said, on the FPI debt side, we are not expecting major flows inward or out. On the equity side, as long as it looks like our growth momentum is going to sustain and that we're going to remain one of the higher growing economies globally, then I think while there may be intermittent outflows, broadly we will see FIIs bringing in more money into equity. And that is something that should support the rupee to some extent going ahead. Even though the global tide and the sentiment towards the US dollar is really what is going to dominate. The other factor is that, when we look at it from a balance of payments point of view, our belief is that the current account deficit was probably going to be at its worst in Q2. So that's the data we get at the end of this quarter. We got a bad number for Q1, but we're probably going to get a much worse number for Q2 based on the Ministry of Commerce data that we've seen so far for the merchandise side and the good data, I mean the fairly robust data that we've seen on the services surplus. But we think that H2, the numbers are not going to be as alarming as Q2. So the balance of payment side should be much more comfortable in the second half of the year as compared to the first half of the year. And it's really going to be the dollar strength, which is going to be the dominant factor. With forex reserves having come down, we think the pace of intervention is probably going to be less than what we may have seen in the last couple of months. So possibly we would expect that there would be a gradual depreciation in the INR movement.
Right. So I think overall still continues. Would it be right to say that we are still in a wait and watch mode?
Sure. I mean, I can't rule out that there will be more depreciation in the INR going ahead. But I feel it's going to be driven more by global factors than necessarily by Indian factors, because I think our own balance of payment situation is going to be more comfortable in H2 than what it was in H1.
Right. So I think these are a few things we should be watching out for as well. But thank you, Aditi, so much for joining us on the show. Always a pleasure to speak to you. Happy Diwali in advance as well, and speak to you soon again.
Thanks, Iral. Happy Diwali to you and all the viewers.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.